Friends, in this video for I Thought Wealth, I am going to talk to you on the topic how inflation is going to bite. It's been 10 years since we saw soaring inflation. We have seen a decade of falling inflation. What did falling inflation mean to our investing? Businesses which had the ability to retain pricing power were able to hold on to the benefits which they got from falling prices. They never passed on all the benefits to the customers. This ensured that they achieved a superior profit growth in an era of falling inflation. They also selectively offered discounts or price reductions in categories where they wanted to grow the category faster. So, instead of investing out of their profits, they were able to invest out of their savings. So, growing their categories was much easier and it happened with better efficiency. This is how businesses achieved superior growth with lower cost to their P&L over the last decade. So, most of the stories of constant compounders are coming with the built-in story of savings and savings contributing to growth, which means that they did not have to invest as much from their profits. They had to invest from their savings. Now, this is a scenario which is a blessing for businesses where showing high growth in profit is a necessity. Typically, businesses which enjoy rich valuations need to show profit growth. Otherwise, the justification for those valuations will not be easy and it will become difficult when profit growth tends to slow or go into the negative mode. We saw 10 years where year after year inflation kept softening and businesses were able to grow and they were able to grow profits too. It's a blessing if a business can grow its sales and its profits without investing its profits fully to achieve higher growth. Now, that scenario is something which played out for 10 years and now we are probably going into a scenario where inflation is going to be higher than businesses can easily pass on. Businesses are already passing on inflation with a lag and they also will need to find money to invest to maintain their growth even at the current levels. Now, maintaining growth itself will need a lot of money to be spent by the company. Effectively, the company will need to give discounts, it will need to give more money to get point of sale presence, it will need to create more distribution outlets. All these things are a running expenditure and a running plan for every business. The fact that inflation is higher will not mean that companies can do it later. They need to do it consistently, and when their profitability goes down because of rising costs, inflationary spiral, then they would need to dip into their profits to continue to do this spending. Now, this is something which is manageable if the inflation comes down in a short period of time. But knowing inflation, it is not something that lasts 4 quarters. It is something that takes momentum, increases and then reaches a place where the central banks and governments decide to convincingly address it and to crush it. Now, that point will have to be reached. Until that point is reached itself, businesses will be absorbing inflation and they will not be passing on. They will be hoping to at least maintain their current level of sales and show some volume growth. And value growth, when it happens, will not be profitable. Now, this is a very important statement I am making. Earlier, when you had value growth in a period of falling inflation, value growth went straight to the bottom line. Now, when you have value growth in an inflationary period, that value growth will only be addressing costs which have already gone up and it will only probably maintain profits as a best case. So, profitability will not grow so easily in most businesses. Now, this kind of a scenario is something which we have not seen in 10 years. This is new for most people who have come into the markets post 2012, and I am sure that they are schooled on a very different thinking. They are schooled to think that some businesses have the ability to keep passing on costs, and that will not affect growth. The first part of the statement is correct, but the second part of the statement is rich. Companies will be able to pass on inflation, but that does not mean that they will get the growth. Look at the statement of Hindustan Lever made just a few weeks ago. They are clearly saying that inflation is now pinching. It is hurting in a way in which it is impacting volume growth. They have managed value growth, but they are not sure about volume growth going forward. If a company of the size and scale and presence of Hindustan Lever is saying that, imagine their weaker competitors. Now, they would not be able to do much if the leader is not going to become aggressive in passing on pricing. And even if the leader passes on pricing, then they need to keep their prices in check, so that when the customer sees the price pinch, he will downtrade into their brand. So, it is going to be a very different story inside each area, inside each sector, inside each product category. But inflation is something which cannot come down when we want it. I mentioned the second part of the statement, which I called as a rich statement, that is, growth will not be affected. Growth will certainly be affected because down trading will happen for the bigger players and people will consume less. Some decisions which they thought were discretionary will get deferred, or even consumers may end up avoiding some things when their wallets are pinching bad. So, we are now heading into a situation very different from what we saw in the last 10 years, and this inflationary bite is not something that can go away in a few quarters. You have just seen the RBI give its forecast of inflation for the next few quarters. Clearly, we are thinking that something better will happen after 4 quarters, which means that we are just sitting and praying. And I know for a fact that inflation is agnostic. It's not going to listen to prayers. It's going to have a mind of its own, and it's going to have a behavior which we cannot predict. And when that behavior comes to hurt companies, then those companies are going to come to the consumer and say, look, I am hurt, therefore you pay me more. And the consumer is going to say, hey, I am also hurt, so I am going to defer my spending, or I am going to buy a brand which is cheaper. So, you are expensive, I will come back to you when you are cheaper and in my zone of comfort. And then you are going to have generic brands which didn't catch the fancy of people, actually catching the fancy of people. Why do you need a floor cleaner which is a super brand? You can use any functional brand. You can use detergents which are cheaper. You can use so many products where down trading won't hurt and people won't even care. And what happens in such situations is that when companies see inflation bite, when bigger brands increase their prices, when that price increase pinches pockets, consumers start doing their own thing. So, they move into their own zone of comfort. They start evaluating which are these products where what I use is not known to others, where it does not matter. And in that frame of mind, he is going to change his preferences. Brand preferences will change. Generics make an entry, and in that scenario, all metrics which we thought are cast in stone tend to crack. And you will see that crack reflect in valuations. Businesses which we thought are completely fail safe and which can deliver growth for the foreseeable future will stutter to give us the growth. You will see revenue growth happening, but profit growth softening. You will see some volume degrowth, and that will in turn give the fear of further damage to investors. So, you will see investor behavior also change, valuations will derate, multiples can come down, and this is something which inflationary scenarios will inflict on us. So, inflation will bite, and it is important that we get ourselves ready for that before it starts biting bad. And in our investments, we should not make assumptions which worked in the last 10 years into the next couple. So, we are entering a very interesting phase of investing. Caution should be the watchword. Don't assume that the past will go seamlessly into the future. There will be a phase of turbulence. The pockets of turbulence can rattle quite a few investors who believed that these things won't happen. Those who are prepared will still be surprised by the ferocity of how change comes before them. Invest sensibly, revisit your assumptions and understand that this bite will last for a while. Thank you for watching this video.